watching the markets with equanimity, away from the noise from your abode in the hills. How does it look now? We did see a very strong resistance coming in at 8,300. Are we now spoiling for a lower low, or do you think that liquidity will keep us in a trading range?
That's a tough one to answer, Lata. First, good morning to both of you. I think it's very difficult to be too bullish or too bearish on the market right now. But, you know, the moment you start leaning too much in one direction, you've got countervailing forces which come in. So right now, I know the earnings season has been quite bad, and it's difficult to pick out very positive straws from the earnings season over the last 1 week. And generally, we've probably come to the end of an emerging market rally or a risk rally that panned out in October. I think what had happened in the end of September is that everybody had gotten too bearish when the market went down to 76, 7,700 levels. I think a lot of the stressed sectors like metals, real estate, etc. had got beaten up maybe more than they deserved to in the near term. And what we saw was a good pullback triggered off by the Fed's pause, which is what panned out into most emerging markets, panned out into most of the beaten down sectors. And I think that was the rally that we saw in the month of October. And I think it has come to an end now at around 8,300 on the Nifty. Now, whether we go back and stabilize in a range of, say, 7,800, 8,300 in the near term, or we go down lower to retest the lows that we made a few weeks back, that I think will take one step at a time. But looking at the earnings and the way things have panned out, I think it's quite difficult to become too bullish at this point in time. So yes, to answer your question, for the time being, I think 83, 8,400 is the top for this market. The lows we'll figure out, but I think there's a good chance that we will probably first go to 7,800, 7,900 and try and stabilize in that 4,500 band for the Nifty. But if earnings continue in the same vein as they have over the last 1 week, then it's not impossible that we go back and retest the September lows.
Okay, Udayan, hi, good morning. Good speaking with you as always. This quarter around, we've seen more losers than winners in earnings season, as you mentioned, even in some of the best-in-breed names. So whether it's an Axis Bank, whether it's a Lupin, whether it's an L&T, and these are stocks that are key holdings in many portfolios. Do you keep the faith at a time like this and use it as an opportunity to accumulate, or do you, step back a bit?
Onyx, Sonia, I am not in the camp which is seeing a lot of green shoots in the earnings yet. You have to be very hopeful to say that what has come out of this earnings season is more positive than negative. Frankly, if you look at every sector, from infrastructure to consumers, even banking, the frontline IT pack, with the exception of the pharma pack, there too there have been a couple of glitches. I don't see too many sectors which have actually delivered the goods. In fact, I would be surprised if there are not more downgrades at the end of this week from the earnings calendar overall. And I think the Nifty and the Sensex earnings per share expectations might also have to be scaled back. And that is the problem with this market. You have these periodic tactical rallies because of global and liquidity factors. And then up comes an earnings season which reminds you that the economic change which the market is trying to price in periodically is just not happening. So you can be hopeful and bullish and say it will happen next quarter. It will certainly happen 2 quarters down the line. But what's happening really on the ground is that with every passing quarter, you're having to push back that expectation saying, oh gosh, 1 more quarter, it did not happen. So maybe it will happen 2 quarters down the line. There's no problem with hoping. It's fine to be optimistic. But if you're realistic and if you're taking on board the numbers as they have come out, it's very difficult to be very optimistic at the end of this earnings season. And therefore, the Nifty is struggling to get anywhere close to the highs it made earlier in the year. Periodically in June, July, August, we heard a lot of people on the channel saying, be prepared for new highs once again this calendar. The Nifty has made a couple of attempts in that direction, but is faltering because earnings are just not giving it the support it requires to get back to that 9,000 level. Yes, domestic liquidity is keeping it supported at a certain level, around 76, 7,800 or 8,000, but I think upsides are limited by the fundamental backdrop.
Okay, then, well, just to tell you where the markets are, they're flat as flat can get. Nifty up about 13 points, Sensex up 13 points, Nifty down 8. So not giving us anything by way of any fundamental direction at this point in time. Among the gainers is M&M, of course, which has reported good numbers, barring the tractor segment for the month of October. And the market's cheering that. Otherwise, there isn't much to read about the pre-market rates. Just now we had the Moody's flash coming in saying that they have upgraded the outlook, not the rating, the outlook on Indian banks to stable from negative. That came from the blue because some of the banking numbers have been quite bad. Your sense, will that do any positive at all, or is Bank Nifty is exactly the one to be avoided?
I wish I could be more optimistic, Lata, about the banking space. But having looked at the numbers this time around and the wrinkles which have cropped up in even some of the blue chip names like Axis Bank, I think valuation expansion from here is a bit of a challenge for the banking space. I'm talking about the private banking space because public sector banking is still very beleaguered. And there's a debate going on in the market right now. But, for the longest time we've said, here is private bank and here is a public sector bank. And the two operate in very different universes. But now looking at the Axis Bank numbers, I think the smallest suspicion that maybe the asset quality pictures are not that widely different between the two sectors. And maybe the private banking universe is being a little bit more artful about how they put out their asset quality picture. That is a brush with which you should not paint every private bank, admittedly. But I think the first hint of suspicion that maybe underneath that calm surface of the gilt-edged private banking universe, there might be some unstill waters. And that, I think, has roiled sentiment a little bit. To talk about the Moody's report, I think what you mentioned earlier in your commentary, the fact that the operating environment going into the next couple of years might be quite challenging in the light of the new payment bank licenses. I read a very nice piece that you wrote in Money Control recently about it, and I agree with very large parts of it. So I think looking at that environment, looking at the kind of the asset quality picture which Axis Bank came up with, and the stressed asset picture which ICICI Bank also unveiled, though the numbers were not nearly as bad as Axis, I struggle to think how there could be any serious valuation expansion that might happen for the private banking universe under these circumstances. So Moody's might help sentiment for a bit or two, but I think the Bank Nifty at best moves with the Nifty, but does not outperform it in any significant manner.
Okay, so no outperformance from the Bank Nifty. I wanted to ask you about a couple of more sectors, Udayan, but before that, the next big trigger that everyone's watching is the Bihar elections. And at this point, the Grand Alliance and the BJP are sort of slugging it out in the last phase, but it could be anybody's game. If the final outcome goes against what the market wants, would you expect to see a big sell-off?
I think the market's preparing itself for a little bit of a shock there. There's no way to call that election result. And I think it's more in the realm of sentiment rather than anything else, Sonia. But you're right that if the NDA comes out on the wrong side in Bihar, there will be a knee-jerk reaction. But does it change a lot on the ground? I know there is analysis suggesting that the NDA might find it more difficult to push through policy. But in any case, there is a tinge of disappointment about the pace at which policy action has been moving over the last many months and quarters. People will not tell you publicly, but privately they will tell you that they are disappointed. So, yeah, in terms of sentiment, in terms of expectations of speedier policy action, in terms of the NDA strength eventually in the Rajya Sabha, these are setbacks. But I think the market probably has priced in half of it already going into the results on the 8th of November. There could be a knee-jerk, but I don't think that is so fundamental. I think earnings are far more fundamental, liquidity flows and expectations of flows next year, the pace at which India is recovering, those things are far more fundamental. So you could get 24, 48 hours of a knee-jerk reaction. I don't read too much into Bihar being such a big deal. So if just for that the market sells off in a big way, I would say that you should go out and probably start nibbling the stocks that you like, because that, in my eyes, contrary to what a lot of people believe, is not such a big game changer.
Oh, really? So it won't be the big binary event, considering that so much of this rally from May 16th onwards was a Modi rally. This won't be seen as a referendum, you think?
Lata, I don't know whether this market is actually going to hinge too many on binary events. We stress too much importance or lay too much importance on these binary events. They come and go. but they don't change the equation for the market in a durable fashion. Look at these binary events and how they've played out in the last couple of months. First, whether the Fed will change rates or not. Will the RBI raise rates or not? RBI changed the game. It raised rates by more than what the market was pricing in 50 basis points. We are still back to 8,000 Nifty. The Fed did not move. How much has the Nifty traversed after these seemingly powerful binary events? So they make a lot of noise while they play out, but eventually the turf has to change. And the turf is fundamentals, which is earnings and growth, and liquidity. Those, I think, are the two core fundamentals which will drive the markets beyond a day or two. Don't put your hopes too much on binary events. They will seem like earth-shattering for a couple of days, but then they'll come and go, and the market will still do its own thing. The market is not moving up or reasserting the uptrend that we saw last year because it is not getting that oxygen from earnings, from growth, from capex, and from more durable liquidity supplies from FIIs. I think these are the things which need to change at the core. Otherwise, you can get tinkering on the margin from central banks. You can get some political outcomes this way or that, but they will not change the landscape in a durable fashion or change the trend in a more meaningful way.
Well, there's something positive also in what you are saying. Economic growth will hold the trump card. We'll come back to you in a minute. Allow you to rest your voice. Let's play you some of the bullseye.
Will be the improvement in earnings, and at some point in time that will come through. So if you want to sort of prepare yourself for that, for the longer term investor with a say a 2 to 3 year time horizon, where should one be nibbling now?
Wow, that's a tough one, Sonia, because, this market has become so bipolar that people just have no tolerance for anything which is not displaying good quality, which is why at one end of the market's very expensive, but they're coming in with good numbers, and pharmaceuticals is a classic case in point. Stocks are very expensive, but look at the numbers of Dr. Reddy's, DV's, as you mentioned, Glenmark. They've been such strong numbers, and they're justifying in a sense, the kind of valuations that they're trading at. But it requires a lot of guts to go out and buy pharmaceuticals at these kind of price levels. The moment you come down the quality ladder, stocks are not that expensive, but neither are earnings good. So it's a bit of a quandary for a lot of people. And this quarter, I think, will challenge the patience of investors who got in early on the domestic theme, the cyclicals, the infrastructure kind of names. The biggest company in the space just came out and said, I'm going to grow my order book by 5% and not 15%. Now, when the companies themselves are telling you that there is an order book problem, do you want to be, as they say, holier than the Pope? Do you want to go out on a limb and say, but I believe that things have turned around with capex and infrastructure companies will do very well? And I think that is the problem with which the market is grappling with. Look at cement. There's a big top-line issue out there. Cement company numbers have been quite weak. Valuations are not too cheap. Do you go out and hope that things will turn around and therefore buy cement? So your question is right on 2 and 3 years out, but so many people who talk about 2 and 3 years out actually do not have the patience to stay the course for 3 years, and they get disappointed. They would have sold L&T this morning. They're saying, we are getting tired of waiting for L&T to turn around, and now they're giving us shocks on order inflow. The same's happening with companies like Thermax and Crompton. So I think domestic cyclicals or companies which are hinging on a turnaround in the domestic economy, they are probably still in a bit of a struggle zone, and it's anybody's guess when they start turning around. So should you be owning them now, or could you be owning them 2 quarters down the line and nothing would have changed with their price? So that's the big point, and I'm now more inclined to be on the second part of it, which is that wait out a little bit, because these stocks are not going anywhere in a hurry the way the economy is shaping up, which takes you back to some of the companies which are delivering, and you have the same list of names. You will go to 2 private banks, you will buy a Maruti, you will buy a few pharmaceutical stocks, but they're already very expensive. So what do you buy? So I think right now, maybe buy in moderation is the thing, because, through this year, you've not made a lot of money from equities, and the waiting game has been a good game. But, you would have made 9-10% in fixed income, and if you bought the index early in the year, you would have been down 2-3%. So fixed income has done better in 2015, and people who've played the waiting game have probably been wiser than rushing into stocks at every opportunity.
Yes, point taken. Then actually, even as you spoke about the economy not turning, we've got the Bajaj Auto numbers and they are not anywhere as good as what they promised to be in September. I mean, September the numbers were actually quite good, much better than what the street expected. Now here comes the disappointment. Sonia, how do they compare with estimates?
Oh, much weaker than estimates, Lata. On all segments, there's been a big fall. Total sales down 9% year-on-year at 3.5 lakhs. Exports are down 19%. So there are some issues with that pie for sure. The export numbers, almost a 20% drop. Domestic sales are down about 1.3 odd percent. And even if you look at the breakup of motorcycle sales down 8%, commercial vehicles down 10%, there is no respite at all. As you rightly pointed out, you know, last month the management did indicate to us that things are picking up both on the export and the domestic front. They've tried their level best with a lot of new launches like the CT100, the Platina, etc. But there is just no pickup at all. They did say that no great fireworks expected in this Diwali, and that's pretty much what's playing out. In fact, the stock is now at the lowest point of trade, down 2.5%. Udayan, wanted your views on, you know, the auto sector. We've seen sort of one step forward, two steps back for this sector for some of the key pockets like two-wheelers, etc. How do you approach this space now? Stay away?
Consumer demand, as you know, Sonia, is a problem. It's not showing up in just one pocket, and that's my biggest problem with this earnings season. It's not stock specific. You know, it's the economy specific. The two engines of this market are consumption and investments. You look at the marquee companies in each of these two spaces. Let's take consumption first. You spoke about Bajaj Auto, but you know, you look at some of the other numbers which hinge on consumption, like Titan, which is getting a pasting today. You look at an ITC, you look at an Emami, you look at a Colgate. There is just no volume growth which is coming through from the consumption side, and that's very, very worrying. You know, you can talk about one Maruti as a lone spark somewhere, but otherwise, anything which is driven by consumption is struggling. Now, it could be because of monsoons, it could be because of some other factors, but the reality is that we are not seeing the kind of consumption boost or drive which should support one half of the market. The other half is investments, and you look at L&T and Thermax and Crompton and cement companies, and you're not seeing that thrust either. So, you know, if these two engines, consumption as reflected in so many stocks or investments, they are not firing on any cylinder, then how will the market climb higher? And that's my point, and that's what you're seeing repeatedly in the kind of numbers which have come through from various sectors across the spectrum this quarter.
Absolutely, and Bajaj Auto is not adding to the cheer of the market at all at this point in time, so now in the red. Before we let you go, there was one question I actually wanted to ask you. Is this all just noise for the markets? This refrain now from many respected people about the intolerance that's creeping up in the socio-political situation. It doesn't hurt economy immediately, but now should we start worrying? Moody's themselves spoke about it, and now we have Mr. Narayan Murthy and several other important voices speaking about growing intolerance. Wow.
That's a tough one, Lata. I can go on for half an hour about it, and this is not probably the forum to discuss something of this magnitude, but it's the elephant in the room at this point in time. Make no mistake about it. You know, when you spend a lot of time in Dalal Street and you move around in Mumbai, where the only thing, or probably the only thing which matters in the circles that we talk in is money, and you will not hear much about the kind of question that you've raised, but I think it's the billion-dollar elephant in the room. And make no mistake, people in the world are taking note of it. But that's probably at another time, another place, and we can have this discussion. But before we say goodbye this time, I wanted to make one point which is related to your question about global liquidity, because that's very, very important. You know, for the last many months, we focused a lot correctly on domestic liquidity because that's been the supporting factor for this market. But I think the answer to whether India can climb back to 9,000 plus and reassert its uptrend depends a lot on the global liquidity inflows that we get over the next 6 to 9 months. And one reason why you're struggling, despite such strong flows from mutual funds, is because that that source of oxygen for the market from FII flows is missing. And there are a couple of numbers I would want to share with you, which you know already. This year, we are probably on track to end the year, the calendar year, with under $4 billion of FII flows. We probably barely crossed $3 billion year to date, which compares to something like $15 billion last year. So we'll probably end the year maybe at 25% of the FII flows of last year. This despite $9 billion of inflows from mutual funds, which have supported the market. But I think this goes on to show that while domestic liquidity does create floors for the market to actually create new highs, you do need constant doses of foreign inflows of capital. Otherwise, your MF money and FII money actually do not equate. The sum total of two might be the same, but on a year, like 2014, we had $15 billion, and you saw what the market performance was like. This year, we've got $3 billion, and the market's down 3% year to date. So the big question going into 2016, given that the Fed will raise interest rates next year at some point, if not in December, is whether we'll get FII flows which are more like 2014 or more like 2015. Because if we do get 2015 kind of flows, then the chances of serious outperformance from the Indian market are not that high. And in that context, I think the kind of returns that India and emerging markets have shown for the 1, 3 and 5 years makes it a very difficult sell or a very hard sell to sell markets like India or any other emerging market. You look at these 3 years, India's up down -5% in dollar terms this year. In 3 years, it's probably up 5%, and in 5 years, it's down 3%. These are 1, 3 and 5 year returns in dollar terms from India. Emerging market Asia, you look at those returns, -8% year to date, -5 or 0 flat for 3 years, and -3% or -1% in a 5 year period. In 5 years, people have not made money from emerging market Asia or India in US dollar terms. That makes it a very difficult sell, and that has a bearing on what we'll get in 2016. That's a big thing to think about and to worry about in terms of expectation of performance for next year.
Thank you very much, Udayan. Always a pleasure speaking with you, and hope we see more of you. To add one more figure to what Udayan is saying, a whole bunch of sovereign wealth funds are selling. Qatar, Kuwait, Norway, Saudi, all of them in the last 2 weeks have reported huge sales. So just to add, FII funds, even the ones based in the developed countries, are not very attracted by emerging markets because we've not given returns over a 1, 3 and 5 year period, as Udayan says. And then there are people who actually have to sell because their budgets are not getting balanced.
Come on, guys, it's a festive season. We can be a little more cheerful. I know you guys have to always call a spade, but a little more cheer this festive season would not harm anyone, right? Then thanks for joining us. We'll touch base with you once again later. But that's a cautious view coming in on the markets. The market, by the way, has also opened up